You are not bad with money. You are just playing a game where the rules were written against you before you even logged in. Two people earn $80,000 a year. One keeps 62, the other keeps 49. Same income, same city, same life. The difference is not luck. It is a three-word phrase that separates payroll employees from wealth builders. I am going to show you exactly how the tax code defines taxable income, why that definition is a legal fiction, and how to legally shift your position from taxed on gross to taxed on net. Most people believe taxes are calculated on what they earn. They are not. Taxes are calculated on what the code allows you to keep after expenses, and the default setting for 97% of Americans is designed to maximize collection, not preservation. Quick disclaimer: I am not a CPA or tax attorney. I am translating the mathematics and structural mechanics so you can ask the right questions. Always verify with a licensed professional in your state. Let us run the actual math, because numbers do not lie, but W-2 forms do. Meet Sarah. She makes $80,000 as a W-2 employee. The moment that money hits her account, the government has already taken its cut. Federal withholding, state tax, FICA, Medicare. By the time she sees it, she has roughly $58,000 of purchasing power. But her tax return says she earned 80. She budgets on 80. She makes decisions on 80. And every year, she wonders why she is falling behind. Now meet Marcus. He earns $80,000 through a single-member LLC. He does not have more clients. He does not work harder. He just changed the plumbing. Under Section 162 of the Internal Revenue Code, business owners are allowed to deduct ordinary and necessary expenses before calculating taxable income. Marcus spends first. He pays taxes on what remains. Sarah spends after tax. Marcus spends before tax. That is not a loophole. That is statutory design. And it creates a mathematical gap of $12,000 to $15,000 per year. Over 10 years, invested at 8%, that gap becomes $240,000. Not from working more, from structuring differently. You might be thinking, I am not a business owner. I do not have a side hustle. I just have a job. Here is what you are missing. The entity shield is not about incorporation status. It is about classification. Independent contractors, freelancers, consultants, and even certain rental arrangements can elect pass-through structures that change how expenses are treated. The barrier is not legal. It is informational. Let us break down the three structural levers that actually move the needle. Not generic advice, actual mechanics. Lever 1. The pre-tax spend protocol. When you are W-2, every dollar you spend on work-related costs comes out of your net income. If you spend $300 on a certification, that is $300 of after-tax money. If you structure correctly, that same $300 reduces your taxable income, which means you keep a larger percentage of every other dollar you earn. The math compounds. But here is where 90% of people fail. They confuse personal expenses with business expenses. The IRS does not care about your feelings. They care about documentation. Ordinary and necessary means directly tied to income generation. A home office deduction requires exclusive use. A vehicle deduction requires mileage logs. A professional development course requires proof of relevance to your trade. Audit proofing is not paranoia. It is architecture. Keep receipts, log hours, separate accounts. If it cannot withstand a 10-minute review, it does not belong on your return. This brings us to lever 2, the qualified business income deduction. Under current code, many pass-through entities can deduct up to 20% of qualified business income before calculating federal tax. This is not a credit. It is an income reduction. It effectively drops your taxable base without changing your actual cash flow. But it phases out at certain income thresholds, and it requires proper entity classification. Lever 3. Jurisdiction and election timing. Not moving states, not offshore schemes. State-level thresholds, local tax reciprocity, and S-corporation election windows. Many states allow pass-through entity tax elections that convert individual tax liability into business-level deductions. This bypasses the state and local tax deduction cap that limits W-2 filers. The election must be made before filing deadlines, and it requires clean books. Now, you might be wondering, this sounds complicated. I am not an accountant. I do not want an audit. Good. You should not want one. That is why the protocol matters more than the theory. Step 1. Audit your current tax treatment. Pull your last return, calculate your effective tax rate, total tax paid divided by total income. If it is above 20%, you are operating in the default collection tier. Step 2. Map your income streams. Identify which ones can be reclassified as business or pass-through activity. Freelance work, consulting, rental income, digital products. Separate the accounts. Commingling funds is the fastest way to lose deduction eligibility. Step 3. Document before you deduct. Create a simple tracking system. The IRS rewards precision, not perfection. Step 4. Consult a CPA who specializes in entity optimization, not just compliance filing. Ask specifically about QBI eligibility, pass-through entity tax elections, and S-corp election timing. Step 5. Reinvest the differential. The tax savings are not lifestyle upgrades, they are compounding capital. Move the retained dollars into broad market index funds, real estate syndications, or debt reduction. Wealth is not built in the spending category, it is built in the retention category. Here is what separates the people who stay trapped in the payroll cycle from the people who build structural advantage. The 97% accept the default setting. They believe taxes are a fixed cost of existence. The 3% treat taxes as a design variable. They do not chase loopholes. They align with statutory mechanics. They do not hide income. They document expenses. They do not fight the system. They operate within its published rules. This is not about getting rich quick. It is about stopping the slow leak. Every dollar you overpay because of structural ignorance is a dollar that cannot compound, cannot protect, and cannot multiply. The tax code is not a moral test. It is a mathematical framework. And frameworks reward those who read the instructions. If you are ready to run these numbers for your specific situation, I mapped every state pass-through election threshold, QBI phase-out limit, and S-corp break-even calculator into a single verification tool. It is free, updated for the current tax year, and links directly to IRS publication references so you can verify the mechanics yourself. Use it before you file, and you will know exactly which lever applies to your income structure. And if you want to see exactly how to structure your first pass-through entity without triggering audit flags or compliance errors, watch this next. I break down the exact documentation checklist and account separation protocol that keeps everything clean, legal, and optimized. The system is built on rules. Most people only learn the rules about penalties. The rules about retention are just as powerful. Start with the math. Verify the structure. Protect the documentation. Your future self will not thank you for working harder. They will thank you for structuring smarter.